Well, it's time to talk investment strategy now on The Pulse, and we've got one of the best in the business to do it with. Richard Lacaille is the Chief Investment Officer at one of the world's biggest money managers, State Street Global Advisors. He oversees the management of more than $2 trillion. Richard, you must be a very busy man. Thanks so much for finding the time to join us this morning. Good morning. Let's talk generally. How optimistic are you that this kind of fragile recovery is continuing globally?
I think it is fragile. We're now at the second stage of the recovery. So the first stage was an enormous stimulus. The second stage, you know, there's some fiscal stimulus still to come, but really you have to hand the baton over to the private sector. So we'll be looking for greater investment by businesses and a little bit of a pickup in consumer.
Beginning to see that now, you know, businesses investing themselves and not relying too much on quantitative easing?
I don't think there's strong evidence of business investment yet, certainly not in the United States. And I think that's something that we need to see at some point, but it could be a little bit early. But this has been an extreme cycle. But you certainly need a pickup in consumer confidence. Now, the jobless numbers are getting a little bit better in the sense they're bottoming out. But I don't think we're ready yet to see a resurgence in consumer confidence. But the PMI numbers, other indicators are easing back a little bit, but they're still at levels that are consistent with growth. So we think we'll get a recovery continuing this year, but it won't be the V-shape that many people have looked for. It'll be more saucer-shaped, as we've been advocating for a long time, and so we'll see more moderate growth.
Now, what about Greece? How big a factor is that?
Well, I think it's a reminder to investors of sovereign risk, and sometimes investors need those reminders. You know, if you look back to the end of 2009, you had, if you like, overbought VIX. You know, the volatility had come down very sharply, credit spreads had compressed, and you could say there was a little bit of an overbought market in that respect. And then the reminder when the data came out about Greece was that there is a lot of risk out there, and people need to be reminded of it. Now, I think the structural adjustment program that's been announced is, you know, it's a reasonably severe program and may put Greece back on a more sustainable path. But we may see spreads remain reasonably high, even though we're not going to see a default that many people have perhaps anticipated in the hedge fund world.
Now, the equity market is up 50% in a year. Do you think that that's sustainable, or are you expecting that you'll see a correction?
Well, obviously, we saw a correction at the beginning of the year. Then we saw some better data come out. We've seen some positive earnings surprises. Few of the earnings surprises were sales-related, which I think is something that investors will be looking for. So despite a very strong fourth quarter GDP number, you know, in many countries around the world, earnings surprises were driven still by cost-cutting or other things rather than sales. So there was a little bit of a slip back. But I think it's always better to look forward rather than, you know, look in the rearview mirror when you're trying to assess markets. And the valuation metrics that we look at would suggest markets are fairly valued, in some cases cheap. And so we've been overweight in equities, and we remain overweight in equities.
Now, what about looking at your institutional investors? They've been fairly cautious over the last year. Is that what you expect to see going forward, or do you expect to see some of those alpha funds giving a little bit more uptake?
Well, I think certainly some of them have not yet rebalanced. You know, they may be a little bit underweight in equities or in risky assets relative to their long-term position. Now, some of those investors find it hard to rebalance because they may face financial strain. You know, might be pension funds with a solvency challenge. Equally, many of them have suffered poor performance on their active strategies and have switched to indexing. So we saw a big wave of that during 2009. To some extent, that's continuing into 2010. But again, from a forward-looking perspective, we think the prospects for alpha generation are actually quite good. And although people have switched to indexing because it's a safe harbour, we think ultimately there'll be an increase in risk-taking in 2010.
And what kind of sectors are you looking at? What kind of spread is there across the board?
Well, within fixed income, again, we've been overweight in corporate credit as opposed to some of the government-related sectors of the market, and certainly agency mortgages in the United States. So overweight a little bit in credit. That's performed well for us during 2009. And it is true that the spreads have compressed a while, and we should be concerned about that from a valuation perspective. But clearly the fundamentals have improved quite substantially, and if our view is correct that the economy will continue in this recovery path, then default rates may have got to the point where value's still there in credit. Now, from an asset allocation perspective, again, we've been overweight in equities, perhaps a little bit overweight now in small caps, more overweight in international equities than perhaps US equities, overweight in the UK, a little bit of underweight in Japan. So a little bit of a mixture, to be honest, but again, an overweight in equities has been the overall theme, at the expense of fixed income and less risky assets.
Okay. Richard, thank you very much indeed for joining us this morning.